Just ahead on today's edition of Money in Your Pocket, Edward Jones financial advisor Rob Fears will be here to help us better understand the financial market. We all hear terms like stocks, bonds, mutual funds, bull and bear markets, but what do they really mean? Stay tuned because at the end of today's show, you'll know what they mean. Don't go away, Money in Your Pocket starts right now.
This program is made possible in part by Credit Union One. Proud to support Money in Your Pocket. Credit Union One offers savings and lending options. Additional information on membership available at creditunion1.org. Loans subject to approval. Accounts are insured up to $250,000. By member's choice, this institution is not federally insured.
Welcome back to this edition of Money in Your Pocket. I'm your host, Lori Banks, and I've got Rob Fears here today from Edward Jones. Thanks for coming by.
Well, thanks for having me, Lori. I appreciate it.
You've never been on the show, so just tell our viewers a little bit about yourself.
Yeah, absolutely. As you said, my name is Rob Fears. I work with Edward Jones Investments. I've been with the firm for a little over 5 years. I was in St. Louis the majority of that time. I came to Charleston to take over a branch office in April of 2015, and since that time I've just been trying to get to know Charleston and get to know the people.
And you are a financial advisor, correct?
Yeah, financial advisor, also accredited asset management specialist and a chartered retirement planning counselor.
Okay. All right, well, we've brought you on the show today to talk about the financial market because we often hear people talk about the market and we don't know what sometimes the market is. So you're our resident expert on the market. So first question, what makes up the market and what is it?
Yeah, and what the market is sort of depends on the person that's saying it. So typically when people say the market, they're referring to one of two things, either the Dow Jones Industrial Average or the S&P 500. When you're watching CNBC,
the ticker going across the bottom.
When you see the ticker, it's usually going to be the Dow Jones Industrial Average and the S&P 500.
Okay.
And those are made up of a couple of different things. The Dow Jones Industrial Average is actually just 30 stocks. So when you look at those numbers, it's interesting to look at the Dow Jones Industrial Average, but we also have to keep in mind that what it is essentially 30 blue chip stocks. When I say blue chip, I mean very large established companies. So we're talking about your Disney, General Electric, things like that. And the 30 stocks that make up that average are actually selected by the Wall Street Journal.
Okay.
So that's one piece of the market that we'll see. And then the S&P 500 is similar. It's also going to be mostly large blue chip stocks, but it's 500 companies.
Okay.
That's why it's called the Standard & Poor's 500. So it's a little broader based index and can maybe give you a little bit better picture of what the entire market is doing.
Okay, so those, like in the Dow, those 30 blue chip stocks, have they been the same 30? Do they change every year, or how does that work?
So again, they're actually selected by employees of the Wall Street Journal.
Okay.
So they don't change every year, but they do change over time. That's the same with the S&P 500 also. So when you look at the Dow Jones Industrial Average or the S&P 500 over time, they actually do add and delete companies based on different market factors. So whether that company still meets their criteria to be included in one of those indexes.
Okay. That's interesting. I never knew that. So that's a trivia question that you can amaze your friends and family with.
There you go.
There's another one called NASDAQ. What is that?
Yeah, so NASDAQ's a little bit different than the Dow Jones or the S&P. So NASDAQ is actually all electronic trading.
Okay.
So when you look at the NASDAQ going up or down, really what that's measuring is what we call over-the-counter securities. So it means they aren't traded on a traditional exchange like the New York Stock Exchange.
Okay.
So when we see the NASDAQ, it's similar. It's just going to be a broad-based index, but it's going to be the thousands of companies that weren't traditionally traded on NYSE.
Okay, so are those the ones that, like if you use like E-Trade or something, that's where those stocks are? Like if you are trading electronically yourself and not using a stockbroker, is that the NASDAQ?
No, that's a good question, but not exactly. So it really refers to more behind the scenes.
Okay.
The reason the NASDAQ started and why it made a lot of sense in the 70s was at that time on the New York Stock Exchange, it was still actually paper trading. There was guys standing, like in the movie Trading Places, where you see the guys running around frantically with paper. That's really what the New York Stock Exchange was. Now they trade electronically also.
Okay.
So when we refer to electronic trading, we're really referring to the actual market makers, the people doing the trading, not the individual investor.
Okay, I see. Let's talk a little bit about the market history, and I know you have a sheet, because as consumers, we just hear the market goes up or goes down. Provide us a little historical perspective on where the market, meaning probably the Dow Jones, has gone over the last 40 years.
Yeah, it's a good point. I think it's really interesting to try and keep those things in perspective, because being a financial advisor, I'm also a human being, so I have emotions when the market goes up and down, just like anyone else. I try to keep it out of it as much as I can. And I think some historical perspective can be interesting when we're thinking about the market. So you mentioned the Dow Jones specifically, and that's why I brought one piece with me that I think is interesting. So when we look at the Dow Jones dropping by 100 points, that can mean different things over time, because the value of the Dow Jones has changed drastically over time. So if we look at in the 1970s, if the Dow dropped by 100 points, that'd be 11.6% drop in that average. It's a pretty significant drop. If my portfolio went down 11.6%, I would probably notice.
Yeah.
The 1980s, that same 100-point drop was a 6.6% drop. So that's more of a dip. Still not ideal, but again, we're changing quite a bit there. The 1990s 100-point drop was only about 2% of that average. In the 2000s, a 100-point drop represented about 1%. And when we look today with the Dow being around 17,000 as far as value, that's about a 0.6% drop. So that same 100 points on a percentage basis has changed quite a bit over the years.
Yeah. I remember I was taking an economics class in the early 2000s, and that's when the Dow went above 10,000 for the first time, and that was such a big deal.
Yeah, it was, and that's where we talked about that the Dow Jones is 30 stocks that are selected by the Wall Street Journal. So what's interesting is even some of those times, the broader market actually had negative returns even while the Dow was climbing over 10,000 and over 11,000 because it's only 30 stocks.
So is the Dow the one that has been in place since the stock market was created? Is that the original one, or was it just not called the Dow back in the 20s when the stock market started?
So the Dow is the oldest index that kind of gives you a little bit of a snapshot of how the market itself is doing. The securities market, or actually stock trading, started long before that. So the earliest examples go all the way back to the 12th century, but I don't want to bore don't want to bore everyone with that. But even the traditional Wall Street that we think about started really in the early 1900s, and the Dow was just after that. It was in the 1930s that Charles Dow actually started the company and began actually following the stock markets.
But if you looked at a graph of the Dow over since the 30s to now, is it always going up? Even though it has dips and sometimes big drops, is it an upward trend?
Yeah, so the long-term trend has always been up. If we look at the Dow Jones Industrial Average, for instance, in 1929, which some people may remember or have read was not a great year for the markets, the Dow Jones Industrial Average was at around 70.
Wow.
Whereas earlier this year in May at its peak, we were in the neighborhood of 18,500. So those numbers can not mean much to people, but we can typically understand that 18,500 is a much bigger number than 70.
Okay.
And really what it tells us is that's how much the index and the value of the markets have moved during that time.
Let's talk a little bit about what makes the market go up and down, because that is what makes the news. You know, the Dow saw an all-time high or low drop today, and that's when regular consumers go, oh my goodness, should I be worried?
Right. So there's a number of different factors that can make the markets go up and down, because we have to remember that the markets are made up of people that are investing in the markets, and there's a number of reasons that people do the things they do. So when we look at what happens in the markets, sometimes there can be fundamentals of a company that have changed. So a company announces that they're going to reduce the dividend that they pay out to their investors. The value of that company goes down, the markets react to that. So sometimes it can be a very solid fundamental reason. Other times it can be that people got scared. So they could hear the Federal Reserve is going to raise interest rates.
Yes.
That sounds bad for me. I should sell some of my stocks. So sometimes it could be as simple as emotions. And it's often as simple as emotions.
So it's when interest rates are going down, that's great for consumers, but for investors, that kind of has a reverse reaction. Like, oh my goodness, time to sell.
So interest rates going up and down don't always directly impact the market. But if we look historically and then also just kind of think about why that would happen. So when interest rates are low, you can borrow money for less money. You can money is cheaper. When money is cheaper, theoretically you can borrow that money and invest it in the market. As money becomes more expensive, it's more difficult to borrow that money and invest it in the market. And there's a number of different factors that can affect why interest rates would have an impact on the market, but that's one very simple example.
Yeah, okay, the interest rates, that's a whole other show.
Right, exactly.
So let's talk about what kind of constitutes the markets. We know it's basically measured by the Dow and the S&P and NASDAQ. So is it all stocks, or what kind of comprises the market?
So again, it's a pretty broad answer. So the stock market is all publicly traded stocks. So most people, when we say the market, what we're talking about is the 30,000 or so publicly traded stocks that exist in the United States. But there's a lot of different markets. So we could be talking about the bond market, the housing market, the stock market.
Okay.
But most people, when they say the market, we're talking about publicly traded stocks.
Okay, so I want to talk about stocks, bonds, and mutual funds, because those are things we hear about a lot on this show, actually. What is a stock?
So the very short and sweet answer to what is a stock is it's a small piece of equity in a company. So when we're thinking about a stock, really what that means is that you own a very small piece of a company. So if you buy a share of IBM for $10, and I have no idea what IBM's trading at, by the way, but you now own $10 worth of IBM. So it really is equity ownership in the company. The reason companies issue stock is they have day-to-day operations they have to fund. It can become very difficult to do that if you don't have many owners.
Right.
So if you and I own a company together, we have to rely on the two resources that we have to raise money for operations, expansion, et cetera. If we have 1 million owners, we have a much larger pool to draw from. So that's really the basic of stock ownership, is that a company sells small pieces of equity in their company to raise funds for various operating expenses.
And basically, if you watch any of the financial shows and there's that thing going across the bottom, that's a lot of times is a stock. It has a sort of an abbreviation and a plus or minus. I haven't looked at one lately, but
yeah, so the stock tickers that go and show either the Dow Jones or the S&P 500, like we talked about, will also sometimes show individual stocks. The reason it's called a stock ticker is because it's a tick move. So when the stock went up or went down, that was a tick. So we have our stock tickers. But yeah, they'll show moment to moment whether the value of an individual stock is going up or going down.
Okay. So the other thing that we talk about, you had mentioned it, was the bond market. What is a bond? I think of a savings bond. Is that the same thing?
So it can be, yeah. I mean, savings bonds are one type of bond in the bond market. And there's several different types of bonds, but if we talk about corporate bonds for a second, since we were just talking about stocks, there's really two different ways that a company can raise money. They can issue equity, meaning they can sell stock in their company, like we just talked about, or they can issue debt. They can borrow money.
Okay.
So when you think about you owning a bond, really what that means is in that scenario, kind of you're the bank. You've said, I'm going to give some of my money to a company or to a municipality or whatever it is, in return for a set interest rate, and after a set amount of years, I'm going to get my principal back. So we'll say, I'm going to pay you 3% interest for 5 years. So the easiest way to think of it is that you're the bank. You're lending somebody money when you're buying a bond.
Okay, that makes sense. I didn't really think about that way. Okay, mutual funds. What are those?
So mutual funds are a little bit of everything. So a mutual fund can be a basket of investments that's stocks or bonds or both, or a lot of different things.
Okay.
Really the idea with a mutual fund is where we talk about the much broader concept of diversification. So most people, as an individual investor, don't have enough money to be properly diversified, to own all the different stocks and bonds that we would have to feel good about having a nice sampling of the entire market. So what a mutual fund does is pool many investors' money together to buy a basket of investments.
Okay.
So instead of you buying one stock for the same price, you can own a small piece of 30. Or instead of you buying one individual bond for a small price, since you were pooling your money with other investors, you can own 30 different bonds. There's thousands and thousands of mutual funds out there for just about whatever taste an investor may have. So again, stocks funds, bond funds. You could say that I want to invest in only companies that are socially conscious or that create renewable energy. So the other nice thing about mutual funds is you can really select what's important to you when you're buying them.
Okay. In your business, when you're talking to just regular folks here in Central Illinois who come to you and they say, oh, I want to start an IRA or a Roth, is a lot of what they're investing in is mutual funds? Is that kind of majority of where most regular people go?
It's very individualized.
Okay.
So the way we start that is we're going to sit down and I'm going to ask you a lot of questions and get to know you and make sure that I know why we'd be buying a stock or a bond or a mutual fund. But if I was going to give a very general answer, it would be that for many individual investors, what can be suitable is mutual funds simply because diversification in your portfolio is very important. And often the easiest way for us to achieve that, unless you have significant resources, is with mutual funds.
All right. So when we look at stocks, bonds, and mutual funds, which of those, if you had to rank them in terms of risk factor, I want to look at risk factor and return.
Okay.
How would you rank them in terms of risk factor or safety?
And I think that's a really important question because when we talk about risk versus return, that's really one of the most important concepts in investing. So I'll say that traditionally, stock investing has been perceived as being riskier than bond investing. There's many different kinds of risk, and again, we only have a little bit of time, so we can't get into all the different kinds of risk. But stock is perceived as having a higher risk of volatility, meaning that the price swings in a stock can go up or down more than in a bond. But what I tell my clients is that we want that volatility, because that's also the reason that historically stocks have had a higher return than bonds over time. If you didn't have the volatility, they wouldn't have to pay a premium return. So that volatility is really welcome to some degree in stock investing, but the price is typically going to fluctuate more.
Yeah. So if you don't like, if you're going to be glued to your TV set or your phone and seeing it going up and down, that's going to create panic. That might not be for you.
Right. Yeah. I mean, it's from a risk standpoint, certainly. Some people like stock investing because it sounds more interesting. Most of the time, if you're talking to your neighbors about your portfolio, you're not going to say, I bought this great bond. It's just not that interesting. But bonds can certainly be a very appropriate piece of a diversified portfolio.
So stocks probably are the riskiest, or then where do bonds and mutual funds, do they kind of go down in terms of risk or safety after that?
So for risk of volatility, I would say stocks are going to be the most risky. Bonds would be after that. And mutual funds, it's really going to depend on the mutual fund, because we could buy a bond mutual fund, which would be less risky than an individual stock.
So will stocks, because they have the most volatility, are they have the highest rate of return? Depending.
Yeah, sure. I mean, it's obviously going to depend on the stock, but historically, stocks have always outperformed bonds over time. And I think the concept of over time is very important. So if we look at 1 year or even 1 quarter, that can be different. What's nice about stocks and bonds, and why we talk about diversifying, is typically stocks and bonds move in different directions. So not always, because I'm sure somebody can find an example of that not being the case, but usually when stocks are going up, the value of bonds are going down. When the value of bonds are going up, the value of stocks are going down, which is why it's important to diversify and own a little bit of both.
A little of everything. I should have asked this earlier. You also hear, you hear about the market. You hear, oh, it's a bear market or a bull market. Who came up with that, and what does that mean for us as consumers?
So I've heard a lot of different theories of who came up with it or why each one means what it means. So I don't know exactly why we call a bull market or a bear market a bear market. Typically, a bull market is just going to mean that we think the value of either the market or the value of an individual security is going to be going up. I think a bear market means it's going to be going down.
Okay.
There's some number sometimes attached to that. So bear market we'll often look at as meaning a 20% drop in the market as being a bear market. But as far as why each one is called that, I honestly don't know.
All right. We want to talk a little bit. It's going to be hard in this show to talk about financial statements because everyone's, just like their Facebook feed, is different. But what should we look for when we get our statement in the mail? I mean, I always look, did it make money or lose money? That's kind of my thing. But sometimes it has a lot of other stuff in it. What in general terms, I know it's different depending on who you're investing with, is in that statement that you're getting?
So typically your statement is going to show a value history over some period of time. So it may say, here's what your account's worth today, here's what it was worth 1 year ago, 3 years ago, 5 years ago. Depending on the level of detail for your statement, it's going to show the individual securities you own, and then same thing, what they were worth over various periods of time. It's going to show a summary of the activity in the accounts. But you're right, for most statements, there's a lot going on there that can be difficult to decipher. So what I like to tell people is make sure that you understand what you own and why you own it.
Okay.
When you look at your statement, you should see different stocks, bonds, mutual funds on there. So I think it's important to have a conversation with your advisor. If you say, hey, the value of this mutual fund went up or went down, and I don't really understand why I even own this. So I think that's the more important question as far as looking at your statements, is really just making sure that you know everything that's in there and why.
So what if you look at your statement and you're like, man, it keeps going down? Should you ask your neighbor, has your portfolio gone down? I mean, when should you be alarmed if it keeps going down, and you should have that conversation with your financial advisor to say, maybe we need to change our strategy here.
Right, absolutely. And that's something that I see with my clients all the time, is that when the value goes down on your statement or whatever else you're looking at, it's never fun. You don't ever want to see it going down. It doesn't mean that you don't know that it's going to go down, but it's not fun to know that it is. I don't know that I would advocate comparing your portfolio to your neighbors. Or even the S&P 500 for that matter.
Okay.
We talked about looking at the Dow Jones and all those things. I think what's really important is to make sure that you've got a written financial plan on paper with your financial advisor, and then look at your performance relative to that plan. So if the value of your investments with us went down over a quarter or a year or whatever it is, how does that impact our long-term plan? Does that mean that something is different, or are we still on track? Is this something that we built into our plan, where we knew we were going to have some years that are up and some years that are down, but we still feel good about our long-term goals? So I think it's really important when we're talking about performance or statements or anything like that, to really tie it to how we're doing in relation to our long-term goals. And hopefully that means that you've got a written financial plan with your advisor.
I'm going to ask you a couple of financial planner questions, and I'm sure you get this a lot. What is your take on when people come to you and say, how much do I need for retirement? And I know that depends, but people are, we get a little worried. Oh, do I have enough? Have I saved enough? How do you tell people how much they need?
And I think that's another one of those where it's a very big question. And it's very tempting to throw out a rule of thumb or a very simple answer to that. And unfortunately, I just don't think there is one. So when we're talking about what you need to save for retirement, I really do think it's important to find an advisor you trust, find somebody you have a rapport with, and sit down and have a discussion about it. It really is something that's too important to use a rule of thumb to figure out. I think you've got to have a plan on paper and know what you're trying to accomplish and how you're going to accomplish it. And what I tell people is, think about the last vacation you went on.
Okay.
Did you say, just give me a rule of thumb on how to get there? You probably didn't. You probably did some planning. You probably figured out when you were going to leave, what route you were going to take to get there, roughly how much it was going to cost, and you may have tweaked that plan depending on the answers to those questions. So most people in a given year are going to spend a lot more time thinking about just their vacation plans and their retirement plans. So again, I just really think it's important to have a plan on paper and really put some thought into it. Even if it's an hour a year, it's going to be an hour very well spent.
Yes, that's a really good analogy about the rule of thumb vacation plan. We don't do that, but we tend to not worry about retirement until you're going to be 45, 50, and like, oh boy, do I have enough? Rob, thank you so much for coming by. I know I learned a lot. I did not know a lot of these terms, and so now when I speak to my financial advisor or I watch TV, now I'll know a little more about what they're talking about.
Well, that's great. Thanks for having me, Lori.
Thank you. Here Here's some takeaways for understanding the market. Historically, the market goes up and down for various reasons, but overall, it continues to grow. Stocks can be looked at as you owning a small part of a company. Bonds can be looked at as if you are operating as the banker, loaning money to a company. And mutual funds are investment strategies that allow you to pool your money together with other investors to purchase a collection of stocks, bonds, and other securities. And finally, when you get your portfolio statement, in general, you'll know how much money you've gained or lost, but it may also show you where your money has been invested and the transactions. If you have questions about that, it's best to talk to your financial advisor. And that's our program for this week. Don't forget, you can always catch up with us online at youtube.com/WEIU.
This program is made possible in part by Credit Union One, proud to support money in your pocket. Credit Union One offers savings and lending options. Additional information on membership available at creditunion1.org. Loans subject to approval. Accounts are insured up to $250,000. By Members' Choice, this institution is not federally insured.